and welcome to the second hour of TheoTrade. I am Professor Jeff Bierman. I'm broadcasting you live from Chicago. Today is Friday. Thank God it's Friday. It's October 3rd. It's 2025. Good morning to the usual suspects. Miguel, Peter Schrader, Bart F., good morning, and thanks for the note this morning. Trains, Rogue Bro, Secret Agent Charlie, Ship, 0330. You got to tell me what that means. Backyard Bob, Michael Gio, Juan Santana, John Fleck. Everybody, good morning to you. So much to say, so little time. We're going to finish up the final three biases today to help unlock and re-mental program you and show you why in this market you can't make money shorting. You will not. You can keep trying to short this S&P 500, but until you understand how the machines work, until you break away from a lot of your biases, it's going to be hard for you to understand that if you don't become a quant geek in this business and get all these bad habits and all these emotions out, it's going to wreak havoc on your trading throughout your career. All right, let me jump to today's theme because I could have taken this in a lot of different directions, But in this case, today's theme is courtesy, and it's on your screen, called funicular. Everybody know what a funicular is? Because I was in Portugal last year, and I know one of our TheoTrade members and a Genesis Cog member lives in Portugal, in Lisbon. That is a funicular, people, on your screen. It is a funicular railway, a type of cable railway system that connects points along a railway track laid on a steep slope. The system is characterized by two counterbalanced carriages called trains or cars, permanently attached to the opposite end of a haulage cable, which is looped over a pulley at the upper end of the track. The result of such a configuration is that two carriages move simultaneously. As one ascends, the other descends at an equal speed. The feature distinguishes funiculars from inclined elevators, which have a single car that is hauled uphill. People, why am I bringing up a funicular? There's no better way to connect with all of you than showing a picture. A picture paints 1,000 words in this business. If you keep shorting stuff on the upslope, you're going to go broke. It's inevitable. You're going to waste your time. You cannot short on the upside. The 2-hour indicator is vertical, the 4-hour indicator is vertical, the daily indicator is vertical, the weekly indicator is vertical. Why the hell would you short this S&P? That's why I never lose money in the S&P. I won't buy it because it's too much risk, but I'm smart enough not to short it because if I'm wrong and that there's a black swan event, it could rip us under reverse at any time. People, this is what a funicular looks like. Let me show you. It's easy to pull it out. You want to see a funicular? This is what a funicular looks like. That's what it looks like. Just take a look at it, people. You're on a funicular. It ain't going down. It's not. It's parabolic. This is the Genesis Cog way. This is why we've nailed so many good trades, more short than even long, because we have the recognition that it's engineered by algorithms. Every single dip is an algorithmic buy. Every single rip is an algorithmic buy. Every single dip is a call buy opportunity. They just rush the market. They buy strength, they sell weakness, and they cross their fingers. The only shot you got of getting this down, you got two shots. Either a black swan event comes out of nowhere that finally breaks the market, or the algorithmic funicular turns around and starts heading down the hill. Why do I bring up the algorithmic funicular? It's simple. Because once we start down the hill, you're never getting out. The ride up is very slow. The ride down is really fast. That's what I'm telling you. So we're just walking up this hill. The market doesn't care about data. It doesn't care about fundamentals. It doesn't care about narrative. You're in a market that's being engineered by these buy programs and by call buying that just jams it higher. We have almost no down days, period, in 6 months. Don't you ever tell me that 70 points is a down day. They run it down 70 and they run it back up. Every dip is a buying opportunity into strength. When does it end? I have no friggin' idea. I'm not going there. Don't send me an email. Where's it going to end? Nobody knows. But I'll give you an idea. Let me give you a puncher's chance where it's going to end. Not how it's going to end, because I don't know. So don't waste your time. Send me an email. Okay, I'm just going to answer it. I don't know. Nobody knows. But here's an idea. The standard deviation channel will never fail you. Use a 1-year standard deviation channel. Your upside to the market is about 250 points. Your downside to the market is about 1,400 or about 5,600. So you got about 1,200 points to the downside. Now, if you look on this weekly indicator, on the weekly, we actually overshot to the third standard deviation. So if we overshoot to the third standard deviation, it could take us to 71, 7,200. So when Garrett says we're going this higher, okay, don't make fun of the guy. Don't disparage him. Don't belittle him. He's probably right. There's a possibility they're going to walk this all the way through 7,000 through the end of the year. It's completely rigged. There's nothing you can do about it. Would I buy this? I would not, because if there's one thing you learn about a funicular, when the railway loses traction, when the tracks break, when there's a, the cogs underneath that, because it happened in Lisbon accidentally a few months ago, where one of the funiculars broke, ran down the mountain, and killed a bunch of people. This is not an exaggeration. This is what this is going to be like. They slowly walk it up the hill, Man Mountain Mike, the hiker, and they thrust it downward. I don't know when this is going to end. I wouldn't play the Kevin Bacon game of chicken where he's on the tractor and Footloose. I wouldn't do that. This is getting stupid. It's getting ridiculous, but it's going to get even more stupid and ridiculous simply because there are no people doing this. This is not people. This is machines with people throwing in call by orders and praying this isn't the day it happens against them. And when it does, they're never getting out. That's one thing. They'll just keep dollar cost averaging into nothing. So you got this working for you. In my model, you can't short a MACD on the way up. You will lose all your money. I have 100% certain that it's not going down. It has to turn and go down. It's the only chance. That's it. Now, this is not a predictive indicator. So any wild news that comes out of anywhere in the world, geopolitical, could reverse this. This is a lagging indicator. It is a in-the-moment indicator, but don't substitute it for prediction. This is just a volatility map. This is the path of least resistance. This is money flowing in. If you keep shorting this, okay, it's Einstein's insanity. You keep doing the same thing every day, you'll lose money, okay? Parabolic MACD, that's a buy. Parabolic RSI, that's a buy. Parabolic money flow. People, I don't think I'm right. I know I'm right. So if you keep shorting this, okay, you need some help, some real help. Wait and pounce. Wait and pounce. That's how we do it at the Genesis Cog. Now, I have every reason to sell this. I have dozens of reasons to sell this. I have an overabundance of, but it ain't going to come down because it ain't run by people. People aren't listening anymore, and machines don't listen. They don't even have any, none of their processing integrates fundamentals. It's just narrative, order flow, and slopes. And the slopes are up, so we just keep going. Here's news for you. Today came out, and this is, courtesy of, and I'll bring my source to you because I have the sources. I don't make them up. There's a company called TheoTrade. Thousands and thousands of people belong to TheoTrade, okay? Thousands. And TheoTrade does what's called correlation work. And what they showed was, TheoTrade shows that there's excessive confidence in this market. That's the word excessive. And there is a pullback imminent. Yeah, when? Look, I love the fact that they point this out. The problem is, Mr. DataTech, the people at DataTech, I love your research. I do, but nobody's listening. If a tree falls in the forest, nobody's there to hear it. Does it make a sound? Nobody's listening anymore. They don't care. Data is irrelevant. Data is only relevant on the way down, not on the way up. So TheoTrade shows correlations for 5 major S&P 500 sectors hit an unusually low level that since 2023 has been followed by a drop for U.S. equities. So there's a 100% chance, probability in their model, that after their model shows excessive confidence, we get a minimum of a 5% pullback. Fine, great. Every other time they've done so, the S&P has declined by 5% minimum to 18% in the following weeks. TheoTrade co-founder Nicholas Colas said in a note emailed Thursday. He's tracking the trailing 30-day price correlations for technology, industrials, consumer discretionary, financial, and healthcare versus the S&P, and they recently fell more than 2 standard deviations below the long-term average, which is signaling that a correction is imminent. My answer is this. I don't have the timing when it's go down. I use my model, and my model is really accurate. But the model is not yielding a trigger or a sell signal at all. But the idea that we're going to get a pullback, duh, This pullback is going to be nasty. It's not going to be a generational buying opportunity. It's more likely to be 5%, a day or two bounce, and then maybe a 10, 20% drop and a toilet flush. My suspicion is it's probably not going to come until the very, very, very last week of November or December, because the manipulators and the permabulls are just not, the powers that be just are not going to let this happen, people. There's too much at risk for them to rig this year and run it, okay? The second one is this, labor pains. It's been reported CGNC stands for Challenger Gray and Christmas. They're one of these think tanks that collects data, all kinds, and baskets it, parses it, curates it, beta tests it, blah, 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 blah. Here is what they showed. The U.S. hiring plans sunk yesterday. They sank to a 16-year low. Companies are not, it's not that they're not hiring. It's that they don't have plans to hire, or if they do hire, it's on an ad hoc basis, meaning that they need it in the moment. So these long-term hiring, this is not something that I want to break to my students, but I have to. I have a class today. I teach at 12:30 to 1:30. It's on capital budgeting. I always get questions for students. Where can I find a job? What does the market look like? Blah, 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 blah. And all I'm trying to tell you is that I have to tell them, the fact of the matter is there's not a lot of jobs for you out there. There's not. The economy's overheated. AI has replaced you. You need to go out and get a degree in programming. You need a degree in data analytics. You need a degree in statistics. You have to become a quant geek or a coder, or you can't get a job. And none of them want to hear this. And some of them think he's so mean. The other ones take my advice and they get a job. I'm plugged into the market. Sorry, TheoTrade members, your kids are not getting a job in finance. You have to go out and position yourself to be a computer quant geek, because they don't have any generalists anymore. They just want you programming, and they want you to be into AI, and that's a fact. The third thing is, I call it fanning the flames. Okay, a report came out this morning on two different sources. Okay, and the two sources said that mega AI deals, and there's tons of them. They're all over the place. It's like a wildfire. It's a conflagration. It's a revolution. It's an uprising, right? Mega AI deals are enabling exits for private equity. So what's happening now is private equity has funded all these massive AI deals that have pivoted and rolled up and into IPOs. They're all over the place. But here's the thing. AI is, the private equity firms are at the height of exiting. This is the highest exiting in the history of private equity right now. Private equity, and Garrett will tell you this, if you want to buy, you buy based upon insider buying. That Garrett has taught us all this. If you want to learn from me, when private equity bails on IPOs, it's the top of the market. That's the top. Private equity is no longer funding these deals. They're looking to exit all the AI deals because they're exiting, as John Elway would tell you, get out on top. Strike while the iron's hot. Get out now. So all these AI deals are heading for the private equities, they're cashing out. They're taking their money and running. It's fueling bubble fears in AI. Don has connected the dots. We're in a bubble. It's clear we're in a bubble. Brandon's connected the dots. We're in a bubble in AI. But the bubble can last a long time. It could last for years, people. You could be hanging out here because, psychology is stronger. Greed can be stronger than fear. And that's a fact at certain times. But in the end, everything normalizes, everything mean reverts. Corey will tell you that. Just wanted to bring these points to you. 4 individual stories today. Interesting stories that should shape your thinking, might shape your trading, might not shape your trading. I just don't know. But let's just throw them out there for the heck of it. First story is this, China syndrome. I don't know if any of you caught this, but this tells you, if you ever want to know, when am I in a bubble? I've given you 100 examples of how you're in a bubble. There's too many to mention. But some of them are just colorization. Some are opinion. This ain't opinion. This is absolute 100% like pure beef fact. So you need to see this. The largest semiconductor equipment. I said the word equipment. I didn't say semiconductor. I didn't say Intel. I didn't say Advanced Micro. I didn't say Micron. Stop. Equipment maker in the world is AMAT. AMAT came out today and they said basically that they have a $500 million shortfall in sales. Did you hear what I said? Oh, it's only got 5 points. Stock should be down 50. This is the top of the chip itself. It's done. If AI, if you hear news on Applied Materials, you got to follow the news. Applied Materials stock drops. The chip making boom. You have to read this. The chip making boom is under threat. Applied Materials said, okay, along with Lam Research, okay, that their revenue from export has been restricted and they're stopping producing equipment. Okay, pay attention to what I'm telling you. Applied Materials is telling, this is what they're saying, sell me. And the market's going, what? What? I'm too busy sipping my margarita and driving my Ferrari down the highway in the Bahamas. That's what's happening here. Nobody's listening anymore because they're all caught up in your beautiful, sexy beauty contest porn charts. That's what's happening. People, this is going to end, and it's going to end really badly. You have every reason to sell. Lam Research is also saying the same thing. We got problems, people. We got problems. And nobody's doing a damn thing about it. Look how overbought that is. And nobody cares. This is the problem with the market. And I'll tell you it again for the 100th time. Nobody cares on the way up about news. Nobody. They only care on the way down. So when a stock blows up and blows out, they're like, what was that? I didn't get that. Okay, by the time you find the story, the stock's crashed. So your story is worthless. Who cares about the story? Nobody cares. The stock's already crashed because it reflects the story. You want to make money with all of us at Theo? Listen to us. Get ahead of that curve. Get out of Applied. Doesn't mean you need to short it. Doesn't. It means you've been warned. Lighten up on these stocks. They're overextended, they're overpriced, and they're starting to warn about, like, you know, the cogs in the machines, pun intended, are starting to slow itself down. I keep telling you this. I will not buy any overbought tech stock. I will not. I'm not taking that ride down. Not. I lived through April 2nd of this year. You're going to see one of those again. They're not fun, and you can't get out of them. All you got to do is you pray to get out. I'm going to wait until it bounces. And when it doesn't bounces, what do you do then? You have no game plan to get out. It's like Mike Tyson says, everybody's got a game plan to beat me until I punch him in the face. Then you have no game plan. You freak out. Get out early and often. Another story, Crypto Keeper. This is really, again, like Crypt Keeper, a little pun there. This has got me all bent out of shape. Now, this stock's rallying $5 today, and for a reason. Visa has now said, don't worry, you don't got to pay us in dollars. You don't. Visa's telling you, you can pay us in stablecoin. You get me, people? Visa is crossing over, and instead of using the US dollar as currency, they're allowing you to use crypto. The first one's stablecoin. What's the next? Who knows? Could be Dogecoin, could be Ethereum. I don't know. That's not my business. I'm just saying, if Visa's going in this direction, that means everybody's going to go in this direction. MasterCard, probably PayPal, that they're going to allow, okay, fiat money to be calibrated in Bitcoin, stablecoin, cryptocurrency. Where might this take us? Maybe a lot higher. But what if it's difficult to actually value or judge or maintain or calibrate default risk? Because nobody knows how to calibrate default risk on crypto yet. They know how to do it on like credit cards. They know how to do it on dollars and cents, but they don't know how to do it here. This is going to get interesting. So if you're wondering, why is the stock up 5? Don's like, financials are up. Yeah, financials are up, Don, but you're missing the bigger picture. The bigger picture is the stock is up today because they're now accepting stablecoin, which is going to move across and it's going to affect MasterCard. PayPal was downgraded. We downgraded it. Moron. Why would you downgrade it? They're going to go in the same direction. Ugh. And the stock trades at a stupid PE level of 14. It's 1/3 of its competitors. Next one on the list today, Southern Cross. Now, again, Southern Cross, there's a pun there. I was going to say, you know, Southern Man, which that doesn't work, but that's a Neil Young song. Everybody knows what Southern Skies are. Southern Skies was a song by Glenn Campbell, but people know there's a song called The Southern Cross. I think it's by Crosby, Stills, and Nash, Southern Cross. All right. The idea here is this. As it were, Genesis Cog has a short position in Southern Company at 94.75. So now the stock is effectively up today. If ever you wanted a signal, if somebody said, what is the signal the market's broken? It's just broken. There it is. They downgraded the stock based upon valuation. A downgrade. The stock opens down, it opens down, and the call buyers come in, rush, and screw the short sellers, or bum rush. That's call buying. That is what's going on, not just in Southern. Every stock is doing this. As soon as it opens down, any high beta stock, any stock where there's strength above the 20-day, they're just rushing the market and saying, we don't care what it's worth. Throw a bunch of calls in there and jam that sucker higher. This is a broken mechanism, people, because this stock was downgraded. It opened lower, and the call buyer said, enough of that crap. We'll use the downgrade to lift this and run it. These are scary times. When I hear a downgrade of a stock at a 52-week high, a downgrade, it makes me think, okay, I should listen. If I hear a downgrade of the 52-week low, I plug my ears and say, put that client on the Bierman crap list, flush him in the toilet. He's worthless. I don't want to hear a downgrade at 52 low. You're worthless to me. All of you are worthless. Don't tell me to sell after it crashes. What good's that going to do? Tell me to get out before the move. That's how you earn and get my respect. This person downgraded, but for downgrading, rallied anyways. Nobody's listening. It's machines that are like, oh, is the MACD positive? Let's just go and buy it. People, I'm warning you. When this goes down, like I said, I don't know the day, I don't know the hour. I think this is going to be the biggest toilet flush we've ever seen. It's going to make April 2nd look like a fairy tale because these stocks are ridiculously overpriced. Their earnings are not getting any better. They have problems with default risk, and it just keeps melting higher because the Fed's pumping liquidity and everybody's just like triggered to buy on the opening. Be aware, eventually when we go down, they have to unwind all of this leverage and unwind all of these overbought positions. It could be fast and furious. I don't think it's going to happen like, gap. I think it's going to be a drip, 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 and then like, bam, like a 300-400 point down day, and everybody's going to be caught off guard. The setup is not there yet, but it will come eventually. Last but not least, barrel of monkeys. Okay. I feel bad for Cracker Barrel. At one point, I owned it. I bought it. I made like 15 bucks on it. I haven't touched it since because it's just broken. I just want to throw this out. It took Cracker Barrel effectively 2 months, the management, to figure out that they're going to fire their marketing group. They hired an external marketing advertising firm to position them. And this marketing advertising firm said to them in no uncertain terms, like, listen to us. You need to change the logo. They changed the logo. They pissed off their constituents. Their brand took a hit. Stock blew down from 72 to 43. What are the lessons you're going to learn from me from this? Number one is the most important thing in all of finance, believe it or not, are not numbers. It's psychology. When psychology turns, you can lose money so fast you'll never come back. This is one of those things where once the psychology turned, the earnings don't even matter. Oh, they made 74 cents. It doesn't matter. It has irrelevant. It's the psychology that the market's like, well, this is like a hot potato. This is a cancer. We don't want to touch this. They're not going to touch this at any price. They're starting to figure this out. If I were the management, as soon as they screwed up, I would have fired that firm and said, nope, we're going back to the old logo. We'll hire another firm. Okay, this is too late in the game for them. But I'm going to give them a puncher's chance. I'm glad that they, barrel of monkeys, the advertising firm who gave them this idea that this was a good idea to change the logo, they're monkeys. The firm is a bunch of monkeys for approving it. They're a bunch of monkeys for letting this happen so late. Pun on the term barrel of monkeys. Would I buy this? Yes, but not yet. This is a technical setup for it to go lower. Remember, the Genesis Cog says that this is not a buy yet. I like the fact that they're cleaning house. I like the fact that they're addressing their image problem. But until that weekly indicator bottoms out, you're not going to make a penny in this stock. Every time it rallies, it'll be sold. It popped this morning about $1.50. The short sellers came in and banged it. Remember, algos sell into downward slopes. That's why it can't gain any traction. And this is a reminder to all you, Once the S&P starts its downward slide, you're not getting out. You're going to buy every day and go, what's wrong? You're on the wrong side of an algorithmic funicular. That's what I'm telling you. The latest trade we took on yesterday, there's our latest trade. There we go. We are now officially short Yum Brands near 152. We make mistakes at the Genesis Cog. We just don't make a lot of them. When we take short sells, we do a lot of research and we never short on the way up. This is peaking and starting to reverse and short on the way down. You can see why this trade is working. Okay. Never short on the way up. That's why we're making money. That's the clue, people. Clue. Next, let's get into the final installment of mental programming. Let me bring you from the current slide. Okay. So it's been a 5-day whirlwind, if you want to call it that. Man, I'm having a really good day on the long side. It's just one of those things where yesterday the longs sucked, the shorts were great. Today I own Merck, it's running again. Things are just starting to break out of my portfolio. It's looking really, really good. We have Cube breaking out CUBE. We do a lot of research. We make sure the key for the Genesis Cog is we make mistakes. We just don't make a lot of them. And we don't make what's called egregious career risk of ruin mistakes, where you're like, I made 40% and in one day it's gone. That'll happen to a lot of people out there in this market, especially, which is unforgiving. Okay, we're going to finish up the final installment of mental programming in progress, eradicating behavioral biases, part 5. Remember, this is the second slide deck, not the first, because we started on Monday and covered a lot of stuff and we just kept overlapping. Now we're going to finish the final 3. Yesterday we did disposition effect, selling your winners and adding to your losers, or letting your losers continue to weigh your portfolio down and cutting short your winners. It's a disastrous strategy that has been proven. It's been proven never to work. It does not work. Add to winners, subtract from losers. That's the proven strategy. Familiarity bias is simply you buy stuff that you're really familiar with. Nothing wrong with it. Just don't fall forever into it thinking that what you love can't go down or what you love can't go up either. Okay, don't fall for that. There are times when to own it. There are times when not to own it. Don't just buy because it's familiar. Familiar helps, but do the due diligence. Mental accounting means you segregate your decisions and that you're willing to lose money for some, but not for others. That is a perverse thinking. Get that out of your damn head. You're never supposed to lose money, no matter what the trade is. Don't lose money. The key to the business, never lose money. Risk first, reward second. Last is experiential bias, which is a form of, hey, I saw this happen over and over. It's going to happen again, and it doesn't. Sometimes you're colorized by thinking that, well, it happened twice, the third time's a charm. It doesn't play out that way. The market will fool you into thinking that your experience will replicate itself over and over. It tends not to. The one we're going to hit first today is herd mentality. I mean, every single one of you, okay, is abundantly knowledgeable on herd mentality. There isn't one of you out there saying, what does the hell does he mean by herd mentality? Come on, every single one of you knows herd mentality. So I'm going to just bring it to you without like being insulting, but herd mentality is what you're seeing now. Like if there ever was a herd mentality market, okay, we're in the throes of it. We're in the epicenter, the middle, the dead center of a herd mentality market. And there's two types of, don't confuse this herd mentality with algos. Algos aren't a herd mentality. People are herd mentality. Algos don't have a soul. You do. Algos don't have a brain. They can't reason. You do. Algos just copycat and follow instructions and optimize instructions. Algos don't have a creative soul. Algos don't have a risk parameter. Algos don't have a sense of risk at all. They're purely mathematically driven, of different shapes and sizes, slopes, order flow, volume, quantity, numbers, moving averages, MACDs. Don't confuse the algo with herd mentality. Algos don't have herd mentality. You do, okay? Because you can break that when you want to. So here's an idea of what herd mentality is in a broader sense. Herd mentality in finance theory. We're not talking about herd mentality in terms of like war, herd mentality in terms of queuing systems, which are lines. We're purely, talking about one thing and one thing only. Herd mentality in terms of trading. It's the tendency of traders to follow and copy the actions of others, often influenced by emotions or peer pressure rather than independent analysis. It means your trading is purely driven by the slope of the chart. And then you go in, and on the 80th day of buying Meta, it drops 70, and you're like, oh my God, I spent 3 years at Theo, and in one afternoon I lost half. Because your herd mentality basically caught up with you. Herd mentality is a killer. It works most of the time, but when it doesn't work, it is one of those things where people don't know what to do when it doesn't work. They have no exit strategy per se. Herd mentality is a behavior that can lead to significant market inefficiencies, such as what? Asset bubbles, which is where we are now, and market crashes. Key factors contributing to herd mentality include things like FOMO. What's FOMO? Everybody knows what FOMO is. It's the fear of missing out. Traders may rush to buy assets experiencing rapid price increases to avoid what's called potential gains. Here's another one. Social proof. The belief that if many people are trading in a particular asset or stock, it must be the right decision. It must be the good decision. And then all of a sudden you wake up the next day and it's like, oh no, Microsoft opened down 40 on a downgrade. Well, it seemed like a good idea at the time because you're all driven by FOMO and herd. Yeah, you're making money for 100 days, but it could be the 101st day that cost you. I never sit there and crack my knuckles and go, I got this. I walk in every day, okay, worried, but not like concerned, but not like fretting. I like the fact that my trades are working, but I don't sit here and go, yeah, they're going to always work. They're not going to work every day. They never do. I have to monitor them day by day by day. I just trade with the algorithms, and when the algorithms reverse polarity, I just want out of them. Or when they hit a certain valuation, or they hit a certain type of like metric on an exit strategy, I just want out. I'm not a FOMO guy. I'm not a herd mentality guy. Herd mentality has cost me millions of dollars from 2000 to 2010. I don't want to play that herd mentality game. It works for a while, but when it doesn't work, it costs you a lot of emotional stress, and it costs you, your pocketbook is usually wiped out. Here's another one. Information cascades. What's that? It's decisions that are made on the observations of others, assuming that their actions are based upon information that's sound, when it's not. It's just purely optics. And here's another one. Confirmation bias. What's confirmation bias? It's seeking information that confirms existing beliefs, leading to reinforcement of group behavior. So you're looking out for other people going, yeah, I think it's going to go higher. And if everybody else is buying it, then it must be the right decision. So, you already confirmed, it was already your idea that was the right decision. And figure if everybody else is buying it, must be the right decision. And the next day you're completely exposed and you get whipped. You're like, what happened here? Like you just get caught by surprise and like, I can't imagine that ever happening again. You never could imagine it in the first place, and it happened anyways. So just throwing that out there. So understanding herd mentality is crucial for traders seeking to make rational, not irrational, but rational decisions and avoid the pitfalls of following the crowd. I am not here to tell you following the crowd is wrong. I'm trying to tell you that following the crowd all the time can be wrong. That's what I'm trying to tell you. Don't ever get complacent. Don't ever sit back with your feet on the desk and tell me, like, I live and die by herd mentality. One day you're going to wake up and herd mentality is going to be the one thing that completely undoes your portfolio and throws you for a loop. And you're like, oh my God, I knew nothing. Exactly. Remember what Confucius said, the path to enlightenment means admitting you know nothing. And that's where you start. Herd mentality is okay as long as you're aware that you're in it, but you don't fall in love with it. And that when it's not working, you got to bail. You have to bail quickly. Here's another way of describing herd mentality. It's conformity of social norms. Does as an attempt to fit in. You bypass personal values. You think that the judgment of the masses is always right. If the greater group is right, it must be right. Or adoption of an ideology of a larger group. AI, whatever's in AI, I'm buying. Did it drop $3? Generational buying opportunity. And you just keep buying and buying because you buy into that ideology. And then one day you wake up and it's like, damn, AI corrected 50%. Be careful. Be careful of the ideology. Do the math, have up the technical indicators, do the fundamental analysis like I do. Make sure you know what you're trading and you're trading what you know. because this business, again, I'm going to quote Don. This business has a way completely of humbling you in ways you can't even imagine. You're like, Bierman, I made 20% this year. Sure. Talk to me when the market's down 25%. You're going to wish, you're like, man, I should have listened to herd mentality, because herd mentality cuts both ways. You have to realize if it works one way, it could be just as bad the other way to the downside. You have to be careful not to buy into every ideology you hear. Another way of categorizing herd mentality is just you have a tendency to mimic the actions of larger groups, because you think, well, if they're upgrading at Guggenheim and they're upgrading at Bank America, that's a reason to buy. Most of the time they upgrade, I sell. I use the upgrade to get out because I know they're selling. They just pump the idiots who get in and then like, now it gives me a chance to get out. Upgrading at 52-week highs is always a sell, people, always. And downgrading at 52-week lows isn't always a buy, but it definitely is not a short sell because it leaves you exposed to being gamma squeezed. Crowd psychology is a major contributor to bubbles. Not believed, it's a fact. People just keep buying and buying and buying and buying. Nothing's ever going down like now. And eventually it turns. I don't think it's going to turn because I think once the market pulls in, I think all of a sudden people are going to say, time to buy. I think this market is so hooked on the juice by the Fed and so hooked on permeable buying. I don't think this market's coming down today. I don't think it's coming down Monday. I don't think it's coming down Tuesday. I just don't. My technical engineers will tell me when it's coming down. They're not signaling a sell signal at all. But that does not mean I'm giving you the green light to buy this. You're in the midst of herd behavior. You're probably towards the latter parts of it than the beginning parts of it. It's easier to be wrong with everyone than right alone. It's tough. Don does it all the time. Tony calls it resistance beats persistence, or persistence beats resistance, pardon me. I take short trades all the time, but my timing has to be perfect. That's the difference. I don't follow the crowd. I just make sure that I don't trade against the crowd. And when I think the crowd's wrong, that I get the timing right. And no one gets fired for buying IBM. Well, if I buy Microsoft, I can't be fired. Wait a second. I stepped in and bought Palantir. Oops, it dropped 50. Doesn't matter. My boss can't fire me. Why? It's Palantir. Okay, you can't think like that. You lose money, losing money in a big chunk, doesn't matter what you trade. Okay, it's going to get you either way. Remember that. So that's herd behavior. Now, two more biases. The next one is called endowment bias. People are like, what the hell? What the hell is an endowment bias? Okay, because a lot of people are just completely unawares of this. Okay, endowment bias is a little tricky thing. So let me bring to you an example of what endowment bias looks like. Okay, it's what we call a bias towards the status quo effect. So let me unpack this for you before you get lost here. Endowment bias in behavioral finance is a psychological phenomenon where individuals, meaning traders, they overvalue an asset or an investment simply because they own it. They just overvalue it. I got it, it's doing strong, and you just can't see otherwise. Okay? This bias can lead to irrational decisions, such as what? Holding on to an underperforming asset longer than necessary. Listen, I bought that damn FedEx. I'm down $50 and I'm not going to sell it. Okay, that's endowment bias. It's stubbornness. It's you're convincing you that you're smarter than everybody else and you're willing to hang on to it even when it's underperforming. Or the opposite side is, I bought that stock. It's up $30. Bierman's a moron. Why the hell would I listen to him? Okay, you're overvaluing your worth and the stock's worth and your intelligence. Just because it's gone up, you're taking credit for something and it's a wildly overpriced asset and then it falls out of the sky and then you've been exposed. It's hubris. It's people's tendency to value something more highly than when they own it than when they don't. Okay, it's very tricky. It's particularly evident with inherited securities that can affect long-term investment strategies. So for instance, behavioral finance scholars have proposed various reasons for the endowment effect, including psychological factors related to loss aversion, meaning I'm not going to let go. I'm short, I'm getting punished on this short, and I'm not going to cover until I prove myself right. That's endowment effect. It's a stubbornness. It's not even self-attribution, which means you're taking credit. It means you're not letting go because you value yourself more than the profitability behind or the logic or the current situation. Your ego's getting in the way. An example is when a rich median or a median owner value for mugs was roughly twice the median non-owner valuation. Okay. Some economists think this reflects something fundamental about the nature of people's preferences. Okay. And incorporating the endowment effect into standard theory implies an indifference curve kinked at the consumer's initial consumption bundle. That's a little bit too academic. I just don't want to go down that particular path of the endowment effect. But the other way of looking at the endowment effect is kind of like looking at something from this perspective, if I may try this upon you. Okay. The emotional value of somebody says, look, the seller perceives that the stock is worth, or your house is worth 700,000, but you go to Zillow or you go to some other listing, multiple listing service, could be Redfin, okay, could be homes.com, and all of a sudden homes.com says it's worth 650,000. You stand up there, you put your hand up and said, screw these people, they're morons. I will not sell my house for a penny less than 700,000. Your decision is based upon emotion, but the market value as it's priced by the crowd says it's worth 650. The buyer will pay you 650, but you're demanding 700,000. That's endowment bias. That's going to hurt you, because eventually what's going to happen is if the market value does fall, you're like, that's it. The market value's now been repriced to 600,000. Don't care. 700,000 or screw everybody. That's your problem. Now you're really suffering from endowment bias. You're connected to your emotions. You're not connected to the rational value of what the market's pricing it at. That's another part of endowment. I'm going to buy the S&P. Bierman's an idiot. I'll pay $67.90 for it. He doesn't know anything. I didn't say I knew what it's worth. I don't know what it's worth. But I can tell you this. When it goes down, nobody knows how to price this thing. But people will pay up for it now. But if it drops to 6,000, they won't buy it. Drop the S&P to 4,000. Nobody's going to buy it. Nobody's going to buy it at 4,000. Why? Well, it's worth more to me at 7,000 than it is at 4,000. No, it's probably worth 4,000. You just overpaid for it. Endowment bias is going to get a lot of you in trouble, where you're going to insist that the value is this on the short side when the value is worth a lot more. And you're going to insist the value is worth this on the long side when truly it's worth a lot less than what you think it is. That's what endowment bias is. There's different approaches to this. I don't want to break this down into too much detail, but the idea here is it's, purchase, transaction cost, familiarity. Don't get hooked on endowment bias. It simply means you're arrogant, you're complacent, you're out of your league. Okay. If you're good at valuing things like myself, and I misvalue things, sometimes here and there, but I never go to value things I don't understand. I'll never trade a biotech stock. I don't know SHIT about it. I'm not going to waste my energy. There's no way I could be vulnerable to endowment bias in a biotech stock because I don't know how to price them. And neither do you. Just based upon price to sales and crossing my fingers of a phase 3 clinical trial, there's no numbers behind it that make any sense. So when I trade stuff for the Genesis Cog people and we do it through my quantum mental model, every one of them leans on me and says, what is it worth? And I tell them, this is what I think it's worth. And I say, listen, if it's worth less than this and I blow it out and I overvalue it, we'll just get out. I'm not hooked on endowment. If I'm wrong, I'm wrong. But I set parameters around my exits. But I don't just sit there and go, it's got to be this. The only time I've ever said that is when I stepped in and said, all right, I'm going to short BAM at 65. I'm not going to let go. I started shorting at 61. Now it's down to 56. Occasionally I will. But most of the time I'm like, nah, I probably valued it wrong. There are certain things I know how to value, certain things I don't know. So I try to lean towards what I know and try my best to fight off endowment bias. Remember, I said that. The last one that's going to close out the week, what I call the mental programming and progress week, the last one, okay, is called availability bias. Again, this is a little bit of a tricky mother. It's a little tricky here, so be aware. I'm going to try to break this down, to demystify it, to simplify it, to make it intelligible to you. It's called availability bias. What the hell is availability bias? Why would there be a bias in an availability of something? So here's availability bias. It's also called an availability heuristic. And people go, what the heck is a heuristic? A heuristic is a fancy term for you've been conditioned to do the same thing over and over. It is a trigger, is a cause effect. I hit my hand and it swings back, whatever. You're in boxing, you pull back. That's what a heuristic is. It's a conditional, like Pavlovian response over and over is what it is. Okay. So what is availability bias? Okay. Availability bias is one of these cognitive biases in behavioral finance theory that leads traders to rely on immediate, in the moment examples that come to mind when evaluating potential risks and outcomes, often resulting in irrational financial decisions. Availability bias refers to the tendency of traders to overestimate the likelihood of events based upon how easily they can recall similar instances. So you're like, oh my God, the market just popped like 50 points, 100 points today. Oh, that means tomorrow it's going to pop another 100. You're absolutely convinced, based upon availability of data that you processed, that it's going to repeat itself in the same way. You're living in the immediate moment. The previous 100 days, what? What are you talking about? All that matters is what happened in the last 24 hours. That's the market we're in. The market we're in is in the throes of availability bias. It's only looking at massive call buying, manipulation by algorithms, a news media that's perma bullish, people screaming 7,000, gotta buy gold. The bullishness and the hubris is rampant. That's availability. You're living in the moment and you've completely have blinders and have blocked out everything prior to the last 48 hours. That's what it means. So in this behavioral finance instance, this bias can significantly influence trading decisions. Investors may give undue weight to recent news or personal experiences rather than considering objective probabilities or longer term probabilities or trends. That's where Don comes in. This is where Don is like, people say, where's the strength of Don Kaufman? The strength of Don Kaufman, to me, is really easy to identify. Don's strength is his ability to shake off immediate events and use his knowledge of option analytics and Greeks and probabilities and IVs to look at things objectively and say, I know this is what it's saying now, but this is what it says over a time-tested duration. That is why Don is brilliant at what he does. He doesn't live in the moment, and neither do I. What I do is I live day to day, but I don't let day to day define and say, well, today's going to be tomorrow and the next day. That's a herd mentality availability bias that people, you are in it. Most of you are suffering this right now. I'm just going to go in every day and buy NVIDIA. I'm buying NVIDIA. I'm buying any day is a good day to buy because you're just living now. You're not thinking like, well, what are the probabilities? What are the expected moves? What are the shortfalls? What are the standard deviations? What are the Bollinger Bands? What are the risks that are involved here? You're living in that tight little window in the second saying, okay, I'm blocking everything else out. I just got to live for today. That's fine if you're Tony Rago. If you're Tony Rago and Corey Rosenblum and you trade intraday, bam, go for it. Don't listen to me. But most of you are not like that. You have to look beyond just today and think, well, what is it going to be a week from now? And a week beyond that, and a week beyond that. Availability bias happens when you judge the likelihood of an event or frequency of occurrence by ease with examples that just easily come to mind that are just now. Most traders are poor at risk assessments. Really? I didn't know that. I've been preaching it for 13 years, 20 years. Most people don't know how to manage risk at all. So for example, they overestimate the likelihood of attacks by sharks or list accidents. For example, when you go on an airplane, okay, and you look out the window and you see another airplane landing and having a landing like problem with their engines or their landing gear, it says in a magazine, time to buy insurance for an airplane. You immediately think, yes, now's the time to buy it. What is the probability of that event occurring? Like 1 in every 400,000 flights? So you randomly run out, buy insurance, and waste a ton of money. The probabilities of that happening are minuscule. But because the event occurred outside your window 30 seconds ago, you think it's going to occur again. It's not likely to occur. It's not. So there's two ways of looking at it. Thinking that it's going to keep occurring over and over and again, or it's not going to occur at all just because it occurred once. So again, there's different ways of looking at that. The majority of people, they're bad at estimating probability, and Don helps you with that. Brandon, Blake, they're all good at estimating risk. After an air crash, more people take the train. Like I said, well, I saw a plane crash. I'm never going to ride an airplane again. I'll take the train, thinking the train can't go off the rails and crash either. There's actually more train crashes than there are plane crashes. But once again, people are ill-informed because the moment colors their thinking, not just for today, but for the next few days, which is dangerous. And then, of course, periods of warm weather affect beliefs about climate change. Once again, people are biting on things based upon what's called the heuristic. It's how the mind processes information and reacts to that information in the moment. You have to be very careful how you do that. Here's another way of looking at this. I like this one. Here's all the information that you need to make a decision for trading. You have to collect lots of information: MACDs, moving averages, fundamentals, asset utilizations, liquidity ratios, solvency ratios, profit margins, earnings, growth estimates. You have a lot of information at your hand. Instead, what you do is this: you just take one sliver of information, it's recent, okay, and all of a sudden it's an extreme outcome, and you automatically extrapolate that this is going to happen over and over again. Oh, Merck jumped, because I own Merck. It was up $6 yesterday. I took some profits. Merck, okay, I bought it at 77. It's at 989. Bounced to 90 today, settling in. Oh, Merck's going to go up $6 again. So you buy calls. What a waste of money. Merck's not going to move $6 now or in the next 5 weeks. It already made its move. Stocks make big quantum leap moves in pharma, and they stop and they just don't move at all. They have to consolidate their gains. They have to mean revert. They have to adjust to the price risk and the risk reward. They don't. Technology can have quantum leaps because of gamma squeezes. It just doesn't happen in stocks like REITs. It doesn't happen in pharma stocks. It doesn't happen in AT&T. If you have one big gap, it's over. They're not going to make another gap. But availability bias says, well, it was really, recent in my head. It was a really big move in AT&T for $4. So it's basically going to happen again. You're completely out of your league. You're misinformed. When things happen to an extreme, the likelihood of it happening again in the shortest period, not good. And just because it hasn't happened for a while, well, the market 6 months ago got slammed on the S&P 500. It's not going down again. Don't think like that. Okay. It might not happen. We might not have one of these in the S&P. And it's been a long time since we've been down. We've been just going up and up and up and up and up. Oh, to hell with it. We're just going to keep going. I told you this is not going to go down until that weekly turns over. I guarantee it. Not even for a day. You got to turn that down. You got to turn this down. So what people are going to do is they're going to keep buying this thinking this is not going to happen, at least not in the moment, because it was extreme for 1 week. Can't think like that. It can happen again. There can be a black swan event, a white swan event that could go up. S&P opens up at 5,000 on Monday morning. What? Oh, the margin calls. Oh, the peer pressure. It's going to be a blowout for all of us, especially those who aren't hedged. Thank goodness I'm hedged. I feel privileged that I'm hedged. Okay? But again, these biases, they are inherent in the way you think. And if they're not inherent, you've been conditioned. You've been socialized to make decisions, to make adjustments, to think that this is the norm, when technically it really is not the norm at all. It is the exception, not the norm. So for the past week, my only goal was to get you to recognize, maybe you don't suffer from all of these different biases, but I almost assuredly you suffer, because I pretty much listed about 15 of them. I'm pretty sure most of you suffer, maybe 16, you suffer from 2 or 3. Hell, I used to suffer from 2/3 of them. It takes a while, years, to break that bad habit and to reprogram or recondition yourself. It's like Pavlovian dog or Albert's little child. You have to stop the heuristics. You have to stop and think to yourself. You wake up every day, okay, turn off the TV, study the fundamentals, study the technicals, study the probabilities, study the statistics, look at the models, check out what Brandon says, me, Blake, Garrett, look at the liquidity, then make the call. But don't think for a second that tomorrow morning we're going to 7,000. We could easily go to 7 just as we can go to 5,000. It can happen. That's why I'm always hedged and I'm always defensive all the time, because I don't think every single day is the same day or predictable. And I don't over lever in trades. I don't underweight trades. Everything is done systematically. I closed out a position today in Tractor Supply. I'm done. I closed out a call spread. Done. It's going down. I don't care. My call spread expired today. It was worthless. 100% gain for all Genesis Cog members. Look how we did this, people. Look, we shorted on the way down, TheoTrade members. We're making money on the short side. Look, we closed out. Done. Closed. Trade closed. Maximum 100% return. New one, Yum Brands. Okay. I know how to manage risk. Can't predict what's going to happen. Just know how to manage the risk correctly. If you can manage the risk, you can become a millionaire. How do I do this? I basically reprogrammed and undid all of my bad emotional biases, and I'm trying to get you to follow. Join the Genesis Cog Mastermind. It'll come in January. I'll have a whole plan for you and get you onboarded. In the meantime, I'm going to turn this over. I believe Brandon is coming in Friday. It's Brandon Chapman Friday. I have got to jump and run. The entire Chicago Avenue is closed. They closed a number of bridges, so the city is in chaos. I have to walk to Loyola. It takes me 40 minutes out of my way to get to and from Loyola because the buses can't get there in time. In the meantime, I'm going to let Brandon Chapman run with this. Brandon, are you with me, man?
I am.
So, Brandon, I got one question before I leave. Where's
Yeah.
the top, or do you even care?
I don't know, man. I capitulated. We went a little more long this week, and so far it's worked out okay.
Again, Brandon, I'm going to say this again. Most of my gains for this year are on the short side. I know that's people like, what? They're on the short side because it's a risk reward thing. That's why.
I know we got a trade that expires today, and it's finally moving, and I'm like, crap, I got to be on here, and it's starting to. We'll look at RX, but anyway.
All
But
right.
well, good luck on your walk. Don't get mugged or anything.
I hope not, but I will walk by Binny's Beverage Depot, and they have the best alcohol in the city. Although I have plenty of alcohol in my liquor cabinet, as it were.
I thought you were gonna say I have plenty of alcohol in my system. No, sorry.
I don't think that I would get by at that at Loyola. Anyways,
Hey,
Brandon.
just cozy up to one of those ice guys and hey, can you escort me to